In this video, we're going to be looking at the 2021 flexible budgeting question. So reading down through the question first, it says Henry Limited manufactures a component for the medical industry. The following flexible budgets have been prepared for 55%, 75% and 95% of the plant's capacity. So we've got the output levels there of 55%, 75% and 95%, and at 55% capacity it's 27,500 units, at 75% capacity it's 37,500 units, and at 95% capacity it is 47,500 units. So you've got the different costs here going down. You've got direct materials, direct wages, production overheads, other overhead costs, admin overheads. It says then that profit is budgeted to be 20% of sales. All units produced are sold. So part A, what is required? So number one, separate production overheads into fixed and variable elements. Part two, separate other overhead costs into fixed and variable elements. Number three, prepare a flexible budget for 90% activity level using marginal costing principles and show the contribution. Part B, Henry Limited is currently operating at 100% capacity and is considering two options as follows. Option 1, modernisation of machinery. This will involve employing one new production supervisor at a cost of 40,000. This will save €1.40 per unit in the production overheads. Option 2, purchase of machinery, which would increase the plant's capacity by 15% while reducing all fixed overheads, including administration, by 5%. Required. Part 1. Prepare flexible budgets using marginal costing principles and showing contributions for both options, taking the new cost structures into account. And Part 2. Advise the company on the best option. And Part C, required. Number 1, what is meant by the term sensitivity analysis? Part 2, outline why Henry Limited would prepare a flexible budget. So 80 marks for that question, so it's 20% of the whole exam. 80 marks, you have 36 minutes to get it done. Okay, so we're going to look at part A first of all. So what is required? So it says separate production overheads into fixed and variable elements. Okay, so how do we do this? To do this, we're going to use the high-low method. So we want to separate the production overheads into fixed and variable elements. So fixed costs are those that stay the same regardless of the output, and variable are those that change with the output. Okay, so production overheads therefore are mixed. They have elements of fixed and variable, and the question is asking us to separate them into fixed and variable. So for us to find the variable cost per unit, what we're going to do is we're going to get the difference between the high output and the low output, because that has to be variable. Why? Because every stage of output, whatever the fixed element is, it's going to be fixed across the board. Okay, so it's going to be fixed across the board. So therefore, any changes have to be variable. So we're going to use the high-low method to do this. Okay, so you can see we've got the outputs in units and we've got the production overheads and costs, and we're just going to have the high minus the low, and that's going to be the difference. So in the units then, 47,500 is the high, the low is 27,500. That gives us a difference of 20,000 units. And in the money, we've got €217,000 minus €129,000. That gives us a difference of 88,000 units, or €88,000. So that has to be variable. So if we want to find the variable cost per unit, we're going to divide the €88,000 by 20,000 units, and that gives us a variable cost per unit of €4.40. So we'll now find the fixed cost, because if you see that the line that you have here, the total cost there, the 129,000, the 173 and the 217, that has fixed and variable in it. So if we take away the variable elements of that, so 27,500 multiplied by 440 is 121, 37,500 multiplied by €4.40 is 165, and 47,500 multiplied by €4.40 is 209. So when we take all of them away, we get 8,000 across the board. So that is the fixed costs. So the fixed costs are €8,000 there. So that's part 1 done. Okay, so again, we're going to use the high-low method to do part 2 and separate the other overhead costs into fixed and variable elements. So again, we've got the high number of units, 47.5, minus the low number of units, 27.5, gives us 20,000 units. And then we've got the high euros, 255,875, minus the low euros, 150,875. That gives us €105,000. So to get the variable cost per unit, what we do is we take the 105,000 divided by 20,000 units, and we get €5.25 is the variable cost per unit. So we then take that 525 and we're going to sub it into, we're going to bring it in here. We're going to multiply all the units by the €5.25 variable cost per unit, and we'll be taking that away from the total cost. So the total cost there, 150, 875, 203, 375, 255, 875. Then we're going to multiply 25,500 by 525. We get 144,375. We multiply 37,500 by 525. We get 196,875. We multiply 47,500 by 525. We get 249,375. When we take the variable cost away from the total cost, we get a difference of €6,500. So €6,500 are the fixed costs, that is the fixed element of the other overhead costs. So that is part 2. Part 3 of that question says, prepare a flexible budget for 90% activity level using marginal costing principles and show the contribution. Okay, so we have to lay this out in a particular way. It has told us to use marginal costing principles, and this is how we'll lay it out now in a second, but we want to do it at 90% activity level. So 55% activity level is 27,500, 75% activity level is 37,500, and then 95% is 47,500. So you can take any one of those figures and divide it by the percentage that you have up on top and multiply it by 90, and you're going to get that the activity level for that then is 45,000 units. Now, when we take these figures here, 152,250 divided by 27,500, take the 206,250 divided by 37,500, and take the 261,250 divided by 47,500, you're going to get that the variable cost is 550, and that is across the board. You do the same thing with the wages, 184,250 divided by 27,500, 251,250 divided by 37,500, and 318,250 divided by 47,500, and you're going to get €6.70 per unit direct labour. Then your production overheads, you did that, you got the high-low method, you use that, and the variable cost there is 440 per unit, and then the fixed is 8,000. The other overhead costs, 525 variable cost per unit, and the fixed is 6,500, and then the admin expenses, 38,500, is 100% fixed cost. So look, now that we have all of those, we can do our flexible budget in marginal costing format. Okay, so we have all the information there. Now, we have, okay, to work out all of the bits. So 45,000 units by 550 is 247,500. Direct labour, 45 by 670 is 301,500. And then 45,000 by 440 is 198. And then 45,000 by 525 is 236,250. And then we've got the production overheads, the fixed element is 8, the other overheads fixed element is 6,500, and then the admin is 38,500. Now, this wasn't meant to show up on the screen there, but when we're looking at the information that it's telling us, it's told us that profit is budgeted to be 20% of sales, right? So profit is 20% of sales, sales is 100, and then the costs are 80. Now, when we add all of those costs together, we get 983,250 and we get 53,000. So that's what 80% is. So if we divide that figure by 80 and multiply it by 100, we will get 1295312.5. Then when we take away the 983250, we get a contribution. So we were asked to show the contribution, and the contribution is basically sales less variable costs is equal to contribution. So this is in marginal costing format. So contribution is 312,062.5, and then when we take away 53,000, we get 259,062.5. So that is the profit there. Now, so marginal costing format, sales less variable costs is equal to contribution less fixed costs is equal to profit. So that is part 3 of A done. So we've got all of this answered now. Okay, so part B is saying to us, Henry Limited is currently operating at 100% capacity. Okay, so 100% capacity, right? What is 100% capacity, right? So if we had, if we divided it out, right? 27,500 divided by 55 multiplied by 100, we're going to get that is 50,000 units. Okay, so 50,000 units. So it's currently operating at 50,000 units and is considering 2 options as follows. Option 1, modernization of machinery. This will involve employing 1 new production supervisor at a cost of 40,000, which will be a fixed cost. And then this will save €1.40 per unit in the production overhead. So that's a variable cost. Okay, that's one of the variable costs, and the 40 is the fixed cost. So let's take a look at that one here first. So 50,000 units, that's the change there, okay? So multiply that by 550, we get 275. The direct labour, 50,000 by 670. So that is the same as previous, okay? So this has stayed the same, this has stayed the same. Then we have production overhead. So 50,000 multiplied by 3. So this was previously €4.40, but it's gone down now to €3. So you're saving €1.40 per unit in this production overhead. So 50 multiplied by 3, 150. Then we have production overheads. We have added a cost of 40, okay, to the production overheads. So 8 plus 40 is 48. Other overheads, we have 50 multiplied by 525, so that's 262,500. Other overhead costs stay the same, 65. Administration costs stay the same, 38,500. So when we add all of them together, we get variable costs of 102,500 and 93,000 in the fixed costs. So that is 80%, because if profit is 20% of sales, okay, so that means that the costs there are 80%, all right, and so the sales are 100%. So with that in mind, then add the we can add the cost together, divide by 80, multiply by 100, we get 1394375. To take away our 1022500, we get 371875 minus 93,000, and we have then that is 278875. So that's option 1. Okay, so our profit is 278875 in option 1. Looking at option 2 then, okay, so purchase of machinery which would increase the plant's capacity by 5% while reducing all fixed overheads, including administration, by 5%. Okay, so again, we're doing part 1 here, which is preparing the flexible budget using marginal costing principles and show the contributions, okay, taking new cost structures into account. Okay, so purchase machinery, increase the plant's capacity by 15%. So it's going to go from 50,000 units, okay, and what will it go up to? It'll go to 57,500. Okay, if we multiply that by 115, it'll go up to 57,500. Okay, and then all fixed overheads then will reduce by 5%, and they're telling us including administration, so all of them will go down. Okay, so this is 115% capacity. Okay, so when 100% capacity was 50,000, 115% capacity is 57,500. So that's the original 550 per unit. The direct labour is the original 670 per unit, but the units is increasing to 57.5. So that's giving us 385,250. Production overheads are going up to 57,500 units multiplied by the original 440. That's given us 253,000. Now, production overheads is going to reduce. So the fixed costs are reducing by 5% each time. So the original was 8,000 euro there. Multiply that by 95%, I get 7,600. Other overhead costs, 57,500, we'll multiply that by €5.25. That gives us 301,875. Other overhead costs then, we're multiplying it by 95%. That's given us 6,175. And then administration, 38,500 multiplied by 95% gives us 36,575. We add all of them together, and again, remember that that is 80%, okay? Because it says that profit is 20%, all right? Profit is 20% of sales. So profit is budgeted to be 20% of sales. So that means that the costs are 80%. We divide the cost by 80, multiply by 100, we get 1633,406.25, okay? That is the sales. We minus the 1,256,375, that gives us contribution of 377,031.25. Then we minus our 50,350, and that gives us a profit of 326,681.25. So I think if we remember that might be a little bit more than the last one. So let's have a look. Advise the company on the best option. So here's the two options. So option one, we have a profit of 278,875. Option two, we have a profit of 326,681.25. So obviously therefore then we're going to go with option two. So why would we say it? So we'd say that option two should be chosen, and you have figures here, so quote the figures. So 326,681, while the profit with option one is less at 278,875, and this is a difference of 47,806.25. So when you have figures, bring the figures into your answer. Okay, so that is that. Okay, part C then, required. What is meant by the term sensitivity analysis? And then part two, outline why Henry Limited will prepare a flexible budget. Right, so what is meant by the term sensitivity analysis? So, sensitivity analysis is also known as what-if analysis. It is a technique used by management accountants to show the effect on profit brought about by changes in the following: selling price, sales volume, variable costs, and fixed costs. Okay, so it's the what if scenario. Okay, so everything that you did there in doing the two different options, that's all sensitivity analysis. Because what if we increased the capacity? What if we reduced the fixed costs? Okay, so all of that is sensitivity analysis. Part two then, outline Henry Limited. Outline why Henry Limited would prepare a flexible budget. Okay, so what's the answer? So to show management the cost levels at different levels of production. So it's misleading to compare the budget costs at one level of activity with the actual costs at a different level of activity. So obviously if you're operating at 55%, you want to see the budgeted cost of 55% and the actual cost of 55%. Okay. Number two, to compare actual costs and budget costs at the same level of activity. So we want to be able to compare 80% capacity at budgeted output and then at actual output as well. Okay. Part three, to compare budgeted costs and actual costs in order to identify variances, which just means differences. Okay. So what are the differences and how can we take corrective action? Okay, so how can we improve it for the future? And number 4 there, to help in controlling costs or planning production levels. So it is misleading to compare the budgeted costs at one level of activity with the actual costs at a different level of activity. Okay, so that is the 2021 budgeting question complete.